I'm John Lesky, recently retired personal financial advisor and founder of finhealth, a tool to guide you to your financial independence. This is the second of 3 videos that demonstrate how the finhealth personal finance software can be used to assess financial health at various stages of life and careers. This video examines the situation of 2 fictional mid-career professional couples, Brian and Barbara Blue and Graham and Georgie Green. Both males are aged 48, with both females aged 46. The previous video examined 2 early accumulator couples with male partners aged 38, with the next looking at 2 professional pre-retiree couples with male partners aged 58. Now, turning to our mid-career professionals, the personal finance software inputs for each couple are shown, first for the blues and then the greens. A close examination of the inputs would reveal that both male partners expect to retire in 17 years at their age 65, with the female partners retiring at age 60 in 14 years. Both couples' income expectations, target growth asset allocations at 60%, and inheritance estimates of $750,000 in 30 years are exactly the same. Their current net worth is also the same at $4.5 million, but the composition is very different. The table on the screen now details their situations. The blues have a greater commitment to lifestyle assets than the greens, implying lower current net investment wealth of $1 million compared with $1.5 million for the greens. While the blues have significantly more investment assets, primarily due to the previous purchase of 2 investment properties currently worth $2.8 million, they are largely debt financed. Brian likes the tax benefits of a debt financed direct property strategy and, like many Australians, believes you can't go wrong with property. The Greens, on the other hand, have virtually no debt and hold the majority of their investment wealth in the tax-effective superannuation environment. It's their intention to continue to direct as much of their future surplus cash flow to superannuation as they can. Both the Blues and Greens superannuation investments are held in highly diversified funds. Spending assumptions also differ markedly, as shown now. The Blues intend to commit more to both lifestyle and lifestyle assets than the Greens, although the differences are not huge relative to expectations regarding income and net worth. On the surface, both couples appear to be doing quite well financially. Without a more detailed consideration of the reasonableness of their expectations, it would be easy to assume that they're both on track for retirement at Brian's and Graham's proposed retirements at age 65. But a comparison of their finhealth personal finance software reports suggests that the Blues have some significant issues to be addressed if they wish to give themselves a high chance of achieving financial independence. As in the previous video, we'll focus our discussion on each couple's personal financial dashboard. The Blues dashboard is shown first. The major issues that the dashboard reveal include the following. 1. An investment wealth ratio that is maximised at a little over 50%, compared with the benchmark of 55% that's regarded as indicative of good financial health. It then slides to close to about 20% at Brian's age 100, as net investment wealth is eroded to support a desired retirement lifestyle. It suggests that the Blues both currently hold and in the future intend to commit too much of net worth to lifestyle assets to be consistent with sustainable, good financial health. 2. A retirement expenditure multiple that rises from a little under zero at the time of the proposed residence upgrade in 2 years at Brian's age 50 to a maximum of about 20 at Brian's age 66, well below the benchmark of 25. A projected $750,000 inheritance at Brian's age 78 enables the Blues to remain marginally below the benchmark for the rest of the projection period. A failure to receive this inheritance would severely jeopardise their lifestyle expectations. 3. The tax effectiveness ratio increases from a current 35.8% to 47.6% at Brian's age 65, suggesting that there may be opportunities to make greater use of the tax-effective superannuation environment. However, as will be discussed next, unless the Blues sell at least one investment property, they will have no scope to direct any more funds to superannuation beyond the legislated minimums hard-coded in the software. 4. A current growth asset allocation ratio of 161.3%, massively above the target growth asset allocation ratio of 60%. The software forces a reduction in the second year and achievement of the target by the proposed retirement date. But a closer look at what the 161.3% growth allocation means is revealing. The current high growth allocation ratio primarily reflects the fact that $2.8 million of investment assets is held as two investment properties, that is, two highly concentrated growth assets. Together with $350,000 of growth assets held in superannuation, total growth assets are $3.15 million. Yet projected lifetime investment wealth is only $1.95 million, comprising net investment wealth of $1 million plus estimated future savings to retirement of $0.95 million. Despite healthy surplus cash flow projected to retirement, $1.5 million is proposed to be directed to lifestyle assets in the form of a residence upgrade. Unless the Blues are willing to immediately sell one or both apartments to rebalance their portfolio, they will carry a growth asset exposure far greater than their self-assessed attitude to investment risk. And, in order to be debt-free at retirement, the projections indicate they will be forced to sell at least one apartment, since estimated future savings will be insufficient to repay current outstanding debt of $2.5 million. The Blues' possibly unwitting decision to hold a massive overexposure to growth assets totally restricts their investment flexibility. If property prices do well over the next 17 years to retirement, this overexposure will appear a smart move. But should they fall, they have no capacity to take advantage of lower prices of either property or any other growth assets, unless they wish to even further increase their overexposure to growth assets. All projected surplus funds are needed to fund the residence upgrade and only partially repay existing debt. Given their attitude to investment risk, such an outcome is likely to be both financially and emotionally devastating. Good financial health dictates they act immediately to sharply reduce their current growth asset exposure. And finally, 5, a current investment diversification ratio of 20%, well below the benchmark of 75%. Again, the software forces the investment diversification ratio to the benchmark by retirement. In practice, however, achieving the benchmark would require the Blues to sell their investment properties and reinvest the proceeds into more diversified investments. The investment properties are large, concentrated holdings that add to investment risk without any compensating expected return, and as such, aren't regarded as consistent with good financial health. So, both currently and prospectively, in terms of the finhealth framework, the Blues' financial health would be rated as poor. They need to quickly reassess the appropriateness of their lifestyle expectations and the way in which they hold their investment wealth. The personal financial dashboard for the Greens is now shown. An examination reveals that 1. The investment wealth ratio rises over time to a maximum 52.8% at Graham's age 78, at the time of receipt of the projected $750,000 inheritance. While falling a little short of the good financial health benchmark of 55%, the complete dashboard suggests it's possibly not a major concern. 2. A retirement expenditure multiple that rises from a low of 5 years at the time of the proposed residence upgrade to a little above 25 at Graham's age 66. It remains above the declining benchmark for the remainder of the projection period, with a sharp jump upwards on receipt of the inheritance at Graham's age 78. It indicates that the Greens' expectations aren't unreasonable, with their projected investment wealth likely to be sufficient to fund their desired retirement lifestyle. 3. A tax effectiveness ratio that climbs steadily from a current 45.3% to a below benchmark level of 66.8% at Graham's retirement at age 65. It suggests that the Greens could potentially increase the tax effectiveness of their projected investment holdings by exploring avenues to more fully utilise the superannuation environment. 4. A current growth asset allocation ratio of 47%, below their target of 60%. This reflects the expectation that a significant share of the projected investment wealth comprises expected future savings or future capital. As these savings are realised, the software employs a hard-coded formula to gradually increase the growth asset allocation ratio to 60% by Graham's age 65. In practice, an investment strategy that results in a more even transition to 60% may provide a better investment experience for the Greens. And 5. A current investment diversification ratio of 86.5%, well above the usual benchmark of 75%, and hard-coded into the software, the investment diversification ratio is projected to reach 100% by Graham's age 65. It can be concluded that the Greens are reducing investment risk by diversifying broadly. So, while the Greens aren't currently financially independent, their expectations appear roughly consistent with achieving good financial health or financial independence by age 65. Of course, things will change along the way, and they should regularly review their position. So, we've looked at two mid-career professional couples that, superficially, appear to be doing pretty well financially. But if financial independence is desired by both, the finhealth approach indicates that the Blues aren't so well positioned, and some changes in their expectations and investment practices should be urgently considered. The Greens' current expectations appear reasonable. The Blues' growth asset allocation and investment diversification ratios are particularly concerning. If they are lucky and property prices maintain a solid upward trajectory to Brian's age 65, they may conclude they made good decisions. But they are currently carrying a large and unnecessary risk that could severely affect their retirement plans, should they ever be forced to sell property to reduce large borrowings at an inopportune time. As with our early career accumulators, the comparison also highlights why you can't base your financial behaviours on what other people that you think are a lot like you are doing. Their objectives and expectations may be very different to yours. Hopefully, you found this video of interest. I'd like to know what you think. Please provide any comments or questions below. And finally, thanks for watching.